Understanding investment risk isn't just about avoiding losses. It's about knowing how to protect and grow your money in a way that actually works for you. Yet most investors overlook one crucial factor that can make or break their financial future. And today, we're making sure you don't fall into that trap. Risk is everywhere in investing. Stocks, bonds, real estate, crypto, every asset carries a level of uncertainty. But here's the kicker: avoiding risk entirely can be just as dangerous as taking on too much. Think about inflation. If your money sits in a savings account earning minimal interest, you're losing purchasing power every year. That's a risk too, just a hidden one. So how do you strike the right balance? Let's break it down. First, there's systematic risk, the kind you can't escape. Market crashes, economic downturns, global recessions, these impact nearly every investment. Then there's unsystematic risk, the kind you can control. Think of it like this. If all your money is in one stock and that company fails, you're in trouble. But if you diversify, spreading your investments across different sectors, asset classes, and even global markets, you reduce the impact of any single failure. Diversification isn't just a buzzword, it's a proven risk management strategy. But here's where most people get it wrong. They think owning multiple stocks means they're diversified. Not necessarily. If those stocks all belong to the same sector, like tech or energy, you're still exposed to sector-specific risks. True diversification means mixing assets, stocks, bonds, real estate, commodities, and even alternative investments. And then there's risk tolerance, your personal ability to handle market ups and downs. It's not just about your emotions, it's about your financial situation, time horizon, and goals. A 25-year-old investing for retirement has a different risk capacity than someone approaching retirement. That's why successful investors don't just pick assets randomly. They align their risk exposure with their long-term financial plan. So, how do you protect yourself? Start with these core principles. 1. Asset allocation. The right mix of investments can help weather market volatility. A well-balanced portfolio reduces risk without sacrificing returns. 2. Rebalancing. Over time, certain investments may grow faster than others, throwing off your ideal allocation. Regularly adjusting your portfolio keeps risk in check. 3. Hedging strategies. Tools like options, stop-loss orders, and inverse ETFs can help cushion against major market downturns. 4. Emergency funds. Investing should never leave you vulnerable. Having cash reserves ensures you're not forced to sell investments at a loss when unexpected expenses arise. And here's a crucial tip. Never invest based on hype. Market bubbles burst, trends fade, and sure things can collapse overnight. A disciplined, research-backed approach always outperforms emotional decision-making. At the end of the day, investment risk isn't about fear. It's about control. The more you understand it, the better equipped you are to make decisions that build real, lasting wealth. This content is for educational purposes only and isn't financial advice. Always consult a certified professional for guidance tailored to your specific situation. What's your biggest investment concern right now? Drop it in the comments. I read as many as I can. And if this helped, you won't want to miss what's coming next. Click the video on screen now.